Welcome back. Chapter 12, we've been waiting for this, right? Because then we know once we finish chapter 12, we're going to get to take a test and be done with this course. Hopefully some of you have appreciated the efforts here to get this stuff up and running and online for you. Your questions have been good. We can, again, if you have more questions, send them in. I can email everybody the answers. Let's, stretch, try, get it done. Don't forget to fill in your online surveys when they come in the last week to give my boss an idea of how well we've done or not. But I do take them seriously, the evaluations. That way I can improve the course next time for the next group of students. And hopefully we'll see you in person soon. Okay, let's get on to chapter 12, capital budgeting. Okay, hopefully you have your notes out, okay, which I updated online. Okay, so go to resources, print out chapter 12 notes. Oh, hit pause first, then go do that. Okay, also, hopefully you've printed out or you have access to look at the examples. Okay, hopefully you've done that already. It's good to read the notes and look at the examples, maybe even look at the homework problems before watching the video. But I understand if you didn't, but make sure you turn in your homework on time. If not, send me a thing that says, hey, professor, I need another couple of days. I've been pretty flexible, but I need two-way communication. All right, capital budgeting. There's 5 main techniques. There's net present value. There's internal rate of return. There's modified internal rate of return. Why do you have modified internal rate of return? Because the internal rate of return has some flaws. Well, then you say, why do we use internal rate of return? Because it's easy to use if you have a financial calculator or Excel. But then if you had Excel, you could use modified internal rate of return. Okay, it's something that's been used historically. People aren't going to get away from it. What we'll get out of this chapter is how it's easy to use, how to implement internal rate of return, and how to use modified internal rate of return, MIRR, so that you'll understand the difference, okay? Net present value, which we mentioned first, that's the best method to use. That considers everything. Considers cost of financing, considers the longevity of the project, considers the investment amount that you're making, okay? There's 2 other methods, the payback method and the discounted payback method. Yes, the discount payback method corrects for some of the things that the payback method doesn't do. Again, there's a reason to use both of these. The payback method facilitates lower level management to calculate whether a project should be done or not based on some directive from above. We'll explain that in a little while. Discounted payback method does the same type of thing, only it accounts for the cost of financing, which the payback method did not do, okay? So the payback method, the capital budget method called the payback method, does not consider cost of financing. We correct with that with the discounted payback method. How? By using weighted average cost of capital and discounting future cash flows, okay? Remember from chapter 11, weighted average cost of capital is a cost of financing attributable to the amount of debt, common and preferred stock that you have. You don't have to worry about calculating that. We'll do that when you get to my Finance 350 class. Those of you that are in it, this should be a piece of cake. All right, now, for all our problems in chapter 12, you will be given the weighted average cost of capital again, so you don't have to worry about calculating that. That's for Finance 350. All right, so the 5 methods: net present value, internal rate of return, modified internal rate of return, payback, and discounted payback. If I'm going too fast, stop, pause, rewind. Sorry about that. Okay. All right. The chapter, however, opens up with another calculation, and we'll go through this one because it kind of highlights this. It's called the average rate of return method, all right? I never used this in the real world. I'm sure there's some people that do. The other 5 people use more commonly as far as I know, but we'll present this one also. If you open your text, if you don't have your text, good time to go get it. Pause, go get your book. When you get back, open to page 5, 6, 7. Okay? 5, 6, 7 in the text in chapter 12, average rate of return method. What are we doing there? We're looking for the average annual income. The average annual income. This will differ from the other 5 capital budgeting techniques that we're going to talk about. Those are all looking at your net cash flow. This one looks at average annual income. So if you're going to make $1 million over 10 years, your average income is $100,000 each year. 100,000 times 10 is $1 million. $1 million divided by 10 is 100 grand. It compares that to the average amount of the dollars you invested to start the project. Okay, the average amount. So here's where the trick is. How do we calculate the average amount of the project investment? Okay, simple. We take the original amount that we paid for the project. So if we bought a new machine for $120,000, it's going to last us for 5 years. At the end of the 5 years, we could sell it for 20 grand. The way to calculate the average investment is take 120 grand initial investment, add it to the residual value. So 120 initial investment plus the salvage or residual value of 20 grand gives you 140 grand. Divide it by the 5 years. 140 grand, hopefully you got your calculators, should be 28 grand a year. That is your average investment. That's how you calculate it. That's kind of the trick in this problem. All right? That's your average annual investment. Okay? So, let's walk through a problem here. All right? So, we have an equipment cost, 350 grand. The residual value, salvage value, what you could sell it for at the end is 50 grand. We add these together to get 400 grand. Divide by 2, that gives us our average investment. Okay? That gives us our average investment. So on the last example, let me correct that. We start out with equipment of 120 grand. The residual value is 20 grand. Add that together, that's 140,000. Divide that by 2 gives us 70 grand for our average annual investment, okay? So the original project amount plus the residual value divide by 2 to get the average investment amount. 350 plus 50 in this example is 400 grand. Divide by 2, our average investment is 200,000. This project is going to last for 5 years. Over those 5 years, we're making $80,000. Take the $80,000 divided by the 5 years, that's average annual income of 16 grand. Take the 16 grand, divide it by our average investment of 200 grand, and we get 8%. That's all there is to it. Again, the equipment cost plus residual value. If the residual value was 0, then it would have been 350 plus 0 equals 350. Divide by 2, you would get 175. When there is a residual value, it's a 350 plus 50 gives us 400. Divide by 2, that's our average investment. Figure out your average income. If you were told the total income over the 5 years is 80,000, 5 years, that's 16 grand a year. 16 over 200 is 8,000. The problem might just tell you the average income is 16 grand a year. And it's just 16 grand a year over the 200,000, okay? Hopefully that makes sense. You could also look in the book on page 567, they talk about it. They have an example there with the cost of machine being $500,000, no residual value. So you divide by 2 and get 250 grand as your average investment. It makes 200 grand over 4 years. That's 50 grand a year. 50 grand over the 250 equals 20%, okay? So you got a few examples there that you can hopefully figure out. We'll also, when we go over the homework in a little bit, we'll get another example. That's the average rate of return method. Maybe some of you noticed I'm not in our classroom 108. I'm up in a conference room. They've got the door locked. I gotta get out of here in a couple hours. All right, classroom 108 is shut down. That moves us on to the 5 capital budgeting techniques that you really have to master. If you're in my Finance 350 class, we use a financial calculator, BA2 Plus. You don't need it for this class. It would be a good idea, okay, especially if you're gonna be in Finance 350, you may as well get it now, it'll make your life easier. If you don't have it, there's tables in the book. We'll use the tables in the book and we'll do some problems longhand, okay, where you can calculate the answers, all right? But you can use a financial calculator. This is the best one, cheap, 20, 30 bucks. You could buy it from kids that had my class before for 10, 15 bucks usually, or online. BA2 Plus by Texas Instruments. It has 5 white buttons going across it, are the things that you're usually solving for. All right, relatively easy to use. Again, 20 to 30 bucks, use 10 to 15 bucks, buy it from a student that had the class before. Okay, so other than the financial calculator, we'll also show you, there's examples online of calculating these problems using Excel. Okay, it's a good skill to know. These are gonna be used and calculated with Excel and financial calculators at any job that you have that does capital budgeting. All right, the appendix, which has tables, I don't know who uses the tables anymore. They used to use them on the CPA exam. I believe they've gotten rid of those. That might be the only valid place where you might get a table to look up, but we're gonna figure out the answers using the tables in your book. In the appendix, in the back, so you can hit pause in a moment, go back and look, appendix A3 and A5, way in the back. There's where the tables are that we're gonna use to answer some of the problems. Okay, moving on. Net present value, best method to use. It compares the discounted value of future cash flows, it discounts them to the present value. Okay, then you add all those cash flow discounted present values up. Do they exceed the cost of the machine you're investing in? Or whatever the project cost is that you're spending today. If the present value of those future flows exceeds the cost of the investment, then you do the project. We'll have a couple caveats later, but the goal is to look for net present value. If the net present value is greater than 0, then the project is a go. If it's less than 0, it's a no. Okay, because it's not adding to the intrinsic value of your firm. If you invest in a project that the present value of the cash flows, which considers financing, results in less money than you're investing in. Sounds like common sense. We need to make sure we understand that. Okay? So net present value greater than 0, the project is a go. Something that may help you, which you'll see in my notes, are timelines. This is today. This is the future. Okay? Maybe a project has 4 cash flows out into the future. You're gonna invest a certain amount of money today. Looking at my notes, what do I have here? All right, I have, let's put these up here a little bit smaller, years 1, 2, 3, and 4. All right, so if you're looking at the notes for chapter 12, we're telling you we're gonna invest $12,000 today. That's a negative, money I'm investing, took it out of my pocket. All right, this one is actually 3 years, so we can go to 3 years. All right, we're gonna get $5,000 at the end of year 1, 5,000 more at the end of year 2, and 5,000 more at the end of year 3. So we are gonna buy a machine that's gonna generate cash flows out into the future of $5,000 each. They don't have to be level. In this example, it happens to be level, okay? Level amounts, all right? So when we're discounting, the method of figuring out what these cash flows in the future are worth is called discounting. It starts with the letter D. That should help you to remember to divide. Okay? When you're discounting, you want to divide. You want to divide to get what the cash flows are worth day one. Everything's with a D. To figure out what the cash flows are worth on day one, divide. That's called discounting. So we're going to divide, but what do we divide by? Okay, in this problem we said weighted average cost of capital is 9%. That's given. That's the combination of the cost of financing for your bonds, common and preferred stock. 9%. So what do? We start dividing. We divide this by 1 plus the weighted average cost of capital, 0.09, okay? Because we're going to just discount it back one period. So that's raised to the 1 power, which is just itself, which is 1.09, okay? Because we want to bring this 5,000 back to find what it's worth 1 year previously. This one is 2 periods previously. So divide by 1.09 to the 2nd power. And this one, 1.09 to the 3rd power. Okay? Depending on your calculation. So you could take 5 grand and go divide by 1.09. When you do that, you will get $4,587. 5 grand divided by 1.09. You can then divide this by 1.09 squared, which is 5 grand divided by 1.09 divided by 1.09. If you know how to use the exponents on your calculator, on this one, you would hit 1.09, there's a y to the x button, hit number 2 and hit enter and you'll get it. So 1.09 y to the x2 equals, and I get a factor of 1.1881. I store that. I take my 5 grand, divide by recall, and what do I get? I get 4208. So you could simply take 5 grand, go divided by 1.9, divided by 1.09, or you can use the exponent. But you're dividing this by 1.09 twice, because 2 times to get back to here. This one, 5 grand divided by 1.09 3 times, and that comes out to be worth $3,860. Make sure you can do this. We add these 3 numbers together. The 3 of them added together come out to $12,655. I'm not worrying about the pennies. Now we compare the 2. Positive 1265 minus the 12 grand, that gives us $265. It's a positive number, so the project is a go. What this means is, if we invest 12 grand into a equipment and it generates us cash flows of 5 grand into the future, remember I'm saying cash flows, not income, because income, we have non-cash transactions in there like depreciation. So we're looking at our cash flows. If it brings in cash flows of 5 grand in the future and it costs me 9% to finance my machine, I'm better off by $265 to do the project. So net present value uses weighted average cost of capital. This is important stuff. It uses weighted average cost of capital. It uses all cash flows that you know about in the future. It discounts them by dividing to get a present value. This is the present value, and this is the net present value. You have to subtract this from this to get to the net present value. This is the present value of the cash flows. This is the cost of the investment. Net present value is positive. This project's a go. All right. We'll do a couple more problems when we're doing the homework. discounting, divide to get to day one's value of the present value, subtract the investment, and you get the net present value. All right, that's net present value. Now, here's a couple of the caveats. When I said if it's positive, you invest in the project. Here's the issue. It depends on your budget. Okay, so you have to have enough money to actually be able to invest. So if our budget allows us to spend 12 grand, then that project is a go. Okay, so unless someone tells you otherwise, all our projects are within the budget, but you should remember that because that's a good true-false type question. If you have 4 different projects, now listen to this because this is important. If you have 4 different projects and you evaluate them all using net present value, the one with the highest positive net present value is the best one. That's the one you're going to do first. If you have enough capacity, your budget is big enough, you will do another one. You might do all 4 if your budget is big enough that you could do all 4 positive present value projects. If your budget is not big enough, you will pick the ones with the highest net present value and do those. Okay? All right. The other thing that you have to consider is whether projects are mutually exclusive or independent. Okay? So I know if you saw the Finance 350 clip on this, I use Starbucks. I've been using Starbucks as an example for years. I'm going to continue because it fits well. There's multiple Starbucks here. Maine and Jefferson, over by Five Guys, up on Washington and neighbor by Jewel at Iroquois and Ogden. There's at least 4. If they decided to open up a Starbucks down the block at Brainerd and Jefferson, some of you might go to it. Okay? So when you're deciding if you're Starbucks, whether you should open up a new Starbucks right on the corner here of Brainerd and Jefferson, that's assuming they let us all back to school someday, so that we'll go there, okay? But assuming they do, some of us might go there, but that might mean we quit going to one of the other 4 that we used to frequent. That is not an independent project, that's mutually exclusive. If they open another Starbucks, a 5th one in the middle of those other 4, it will generate some new customers and new sales. But some of its sales will be cannibalizing sales that would have occurred anyway at Starbucks at one of the other 4. So when you evaluate a project like that, we won't do that in our class, okay? When you evaluate a project like that, you have to take into consideration the negative impact creating to the other stores when you're figuring out the cash flow. So if you got a positive $6,000 month cash flow from the new Starbucks, but you lost $1,000 each from the other 4, your net benefit is only $2 grand, okay? Because you lost $1,000 of cash flow from the other 4. If you open that new store and it doesn't have any impact on the other 4, then it becomes independent. But we won't know that unless we analyze. I'll go back to my Walmart example. If Walmart decided to open up a new store in Rockford, Illinois, it will not have a negative impact on the Walmart in Naperville or Peoria or Champaign. It's independent. It's not going to take away sales and revenue and profits from a nearby Walmart. It's independent. So mutually exclusive just means it's close enough that it's going to cannibalize some sales from other stores or profits. Okay? Or you can look at it as a new product line. When McDonald's went to all-day breakfast, they obviously did it because it has a net present value that's positive, but it did hurt some hamburger sales. Because now if you go there at 2, you might get a sausage McMuffin instead of a quarter pounder. So they have to figure out how many more customers come that wouldn't have come at all to buy the Egg McMuffin at 2 o'clock in the afternoon versus how many people will not buy the quarter pounder. And they have to analyze that negative piece along with all the positives. Okay? So expanding your product line, just as expanding geographic locations, those can be independent or mutual. It's going to depend. All right? That's a true-false type question. Okay? Are we concerned with other locations if the project is independent? No. Are we concerned about other locations if it's mutually exclusive or other product lines? Yes, that's the definition of mutually exclusive. If I, again, stop, pause, go back, rewind, make sure you get that concept mutually exclusive versus independent. It applies to all the projects that we look at. That moves us to internal rate of return. Okay, internal rate of return by definition, again, we're gonna look at a timeline. Internal rate of return by definition is comparing the cash flows in the future, discounting them, and it's solving for that interest rate that equates the future cash flows to exactly the investment amount. Okay, so let's think about that. Why do we do that? If we figure out what interest rate, what weighted average cost of capital, when discounting future cash flows exactly equals the investment amount, then if our cost of financing is less than internal rate of return, the project is a go. If weighted average cost of capital is greater than the internal rate of return we calculate, then it is a no-go. All right? So internal rate of return, if it's greater than WACC, then the project equals go. If the internal rate of return is greater than the cost of financing the project, then we go ahead and we do the project. Okay? So if we look at my notes, second page of notes here for internal rate of return. The way the book has us do it looks at the appendix. We're going to do it that way. Later we'll look at some Excel. Okay? Internal rate of return. I have a timeline again. Same one. Year 1, year 2, year 3. We invest $12,000. All right? We have $5,000 investment. All right? Because we have to use the appendix, all the examples that we will use and do will be with even cash flows. We know that doesn't exist in the real world. That's why you would use a financial calculator or Excel, but we'll stick with even cash flows. So they're telling you you're investing 12 grand, you're getting 5 grand a year. And if we tell you the weighted average cost of capital, if we're using the same problem, then it was 9%. Now notice the 9% isn't used in the calculation here. What do? We take the investment divided by the cash flow. 12 grand, don't worry about the negative, over 5 grand. That equals 2.4. Okay? So all you do, it only works to use the table when you have a cash flow that's even. All right? Yes, you can probably figure, we can get into more detail and figure out a cumbersome way to use the tables. If it's not, we're not going to do that here. We're going to just use the simple method of when the payments are even, take the investment divided by the cash flow. You get a factor. We go to the appendix way in the back. So now you know why I had you get that earlier. And I'm looking for appendix A5, way in the back. You'll see a couple of yellow pages. And you're going to look down in the first column, it says periods. How many years were in this cash flow? 3. So we're going to look for the 3 period. We're going to go across the table. At the top, there's interest rates going from, what's that, 4% up to 14%. So we're going to look at row 3, the period 3, because there's 3 cash flows coming in. We're going to go across, and we're going to try and find something really close to 2.4, the factor. This is called a factor. 2.4, and it's right at 12%. We're really close at 12%. So we're looking in period 3, because this is 3 years of cash flow. The factor in the book is about 2.4, so we will estimate a 12% internal rate of return. That's all there is to it using the appendix. The investment divided by this, get a factor, make sure you know you're using A5, table A5, for the internal rate of return method. Write it in your book right now, on the top of A5, right, for internal rate of return. Okay? Write it small if you're selling the book. All right? Do we accept this project? Yes, because internal rate of return is greater than weighted average cost of capital. It's that simple. This is greater than this, accept the project. Again, we got to keep in mind our budget, mutual, exclusive versus independent. This is greater than this, otherwise do the project. If we change the weighted average cost of capital to 8%, it doesn't change this. If we change this to 7%, it doesn't change the internal rate of return. We didn't use weighted average cost of capital to discount like we did in net present value. We're only using it as a benchmark or hurdle rate. Okay? So if the weighted average cost of capital was 15%, and we calculate internal rate of return, 12, we don't do the project. But we were given 9, 12 is greater than 9, do the project. All right? Problem with the internal rate of return. When you get this 5,000, it presumes you will take it and invest in another project that earns exactly the internal rate of return. And then 2 years out, when you get this $5,000, it presumes you will invest in another project making 12%. That's an incorrect assumption. When you make money in the future, you will look at what projects are available in the future to make. You will invest in any project that is greater than 9%. So if there's a project that will make you 10 or 11%, you will use it. You'll use this $5,000 to invest in that project because it's greater than weighted average cost of capital. If there's one that's 18% or 20%, you'll use it. Okay? If the only available projects that are out there earn less than the 9%, you won't invest in those projects. So internal rate of return has a flaw that it presumes all future cash flows are invested at the internal rate of return. Bad assumption. That's why it's not the best. Net present value is better. Okay? Yes, if you're in my finance class, we also talk about if the cash flows vacillate from positive to negative, it can actually result in multiple internal rate of return answers, which is confusing in of itself. Another reason not to use this method. So internal rate of return is easy to use if you have a table or a financial calculator or Excel in front of you. That's why people use it. It's historically been used. That's why people use it. Since we know there's a problem, and that it assumes these cash flows are being reinvested at the internal rate of return instead of WACC, we've modified it. So we've come up with a modified internal rate of return. So now we'll add an M to the front of this, and we have the modified internal rate of return method. Modified internal rate of return. Multiplies. So the modified multiply. Modified is multiply. The modified internal rate of return, we're going to multiply instead of divide. Because we're not discounting, we're looking for out into the future. Modified internal rate of return, M for multiply. We need to create future values of the cash flows. Okay? What does that mean? We're now trying to figure out what everything is worth in the future at the end of the payment stream. This $5,000, when we get it 3 years from now, it's worth exactly itself. This $5,000, when we get it, we can invest it for 1 year. When we invest it, we won't invest it unless we can get at least our 9%. So we're going to multiply. We're going to multiply this by 1.09 to the first power, which is simply 1.09. Why? Because it's 1 year that we get to invest it till the end of the term. Okay? The timeline goes to 3. The payment we get at timeline 2, 1 period, so multiply it times 1.09. Okay? You got your calculator out, you can help me. You can do that calculation. 5,000 times 1.09, that's gotta be what, $5,450, I hope? All right, where's my calculator, just to double check. 5,000 times 1.09, good, 5,450. This $5,000, when we get to invest 2 periods. So I'm gonna multiply that 1.09 to the second power. This is where people make mistakes. They wanna divide it. No, modified internal rate of return, multiply, M&M. Okay, 5 times 109 is 5450. 5,000 times 1.09 squared, or 1.09 times 1.09 gives me 5940. So I add all through, don't forget this one, because we get that money too. Don't multiply this by anything. 3 of you will, please don't do that. This plus this equals $16,390. Okay? $16,390. Now that we have that, we look for a factor again. How do we get the factor here? 12,000, the investment amount. Again, it's on top. Over 16,390. That equals 0.732. We head to the back of the book. We're looking for Appendix A, which happens to be right before Appendix B. This time, we're going to look at Table A3. So for this one, we're using A3. Why? Because it's a single payment rather than cash flows. We've turned all the multiple payments into one number. Table A3, the factors that we create for single numbers are found there. So what do we have again? We have 3 periods. So we go to the 3 periods. At 11%, we should see 0.73119. At 3 periods, table A3, you should see 0.731 something or other. It's close enough. So that means the modified internal rate of return on this project is about 11%. Okay? Not what we calculated previously. In the modified internal rate of return, we get 11% versus internal rate of return was 12%. It's still a go because this is greater than the 9%. 11 is greater than 9, do the project. Okay? 11 is greater than 9, do the project. If this would have come out to be 6, 4, 3, don't do the project. Mutually exclusive and independent would count again. Total budget counts again. Don't worry about that. Something you should know from a true-false perspective, but 11 is greater than 9, do the project. You can see it's a little different than internal rate of return. If there's questions, email me, please. Okay, so now we've done net present value, internal rate of return, modified internal rate of return. We can see that the modified internal rate of return actually does use the weighted average cost of capital. So if we change this, it changes all our answers. Internal rate of return, if you change this, it just changes the hurdle rate. You don't use this number anywhere else in internal rate of return. Okay? So given a cash flow, and you're told to calculate internal rate of return, if we change the interest rate for WACC, it's still the same answer. You still get the same internal rate of return, just a different hurdle rate to compare it to. Hopefully you can understand multiply, modified internal rate of return. Okay? I'd say this would be a good time to take a break, because I'm gonna switch to the payback stuff. But you can take a break at any time, because this is a video chat. You can pause it and take a walk and come back later. At any point. But now might be a good time. When you come back, I'll still be erasing the board though. All right. Hopefully you didn't wait till the day before the final to watch this video and get your homework turned in. Sooner you get the homeworks turned in, the sooner I'll send you the answers. The sooner I will try and explain to you any mistakes I see. Okay? We did great on the Chapter 7, 8, 9 tests. Some of you are so happy that you're able to do these at home and take your time in a relaxed atmosphere. Let's take advantage of that. Let's get some more 18, 19s, and 20s. Okay? We didn't have any disasters. Let's do the same on our final. Okay? Please. All right? Like I say always selfishly, it was much easier to correct them, except for the guys that took pictures and then put them in. So then I'm sitting and my wife's going, why are you doing that? I go, because they sent me the pictures sideways. She said, rotate the screen. I couldn't rotate the screen. So I had a crick in my neck for about 2 hours after correcting the test. But that's okay. So let's move on to those last two methods, payback and discounted payback. I don't know why, I said this in the Finance 350 class, payback method for some reason confuses people. If you got $200 in your pocket, someone tells you about an investment you could make, and it's going to cost you $200. So you give them the $200, and they tell you you're going to earn $100 every year for the next 20 years. How long till you're paid back? 2 years. You took 200 out. At the end of year one, you get 100 back. End of year two, you get 100 back. You're paid back. That's the payback method. How long till you got the money that you took out of your pocket back? Okay? If they tell you, we need $300, and you happen to have $300, and it's going to pay you $75 a year. In 4 years, 4 times 75 is 300. You got your 300 back. Payback. You're paid back. Notice I didn't use weighted average cost of capital. Okay, so this is another one that has an inherent problem. It doesn't consider the cost of financing. This is kind of what we were doing in Chapter 11. We weren't worrying about cost of financing. Now we're worrying about it because we end up with the discounted payback method. But in the payback method, we don't worry about it. So if I took $300 out, I'm going to get $75 a year for 50 years. All I care about is at the end of 4 years, I'm paid back. All right? So sometimes it doesn't come out exactly even. So I have $250 in my pocket, and they tell me I'm going to get $100 back every year for 48 years. At the end of the first year, I took $250 out, day one. At the end of the first year, I get $100 back. Did I get paid back? No, I'm short $150. Year two, they send me another $100. Did I get paid back? No, I have 100 and 100. It's 200. I took out $250, I'm short $50. How much do I get back the third year? I get $100 back the third year. So I only need 6 months of the third year, half the year, till I get $50 back. So the payback period, 2.5 years. It's that simple. Okay? Don't let it confuse you. The payback and discounted payback both give you quick looks into liquidity and risk. Oh, isn't that important nowadays? Liquidity and risk. We want to know how quick we're getting our money back. Okay? Think of all the corporations that invested in projects and didn't consider how quick they were going to get paid back. They're borrowing money from the federal government. They probably had to issue warrants and dilute their stock, and their shareholders are upset. Maybe their bondholders had to take adjusted terms. What a disaster. Anyway, remember when we had people coming here to present wealth management ideas, that first bucket, emergency fund. Where was the emergency fund? They figured they can go and borrow money from the bank if something bad happened. The problem is when everybody comes to the bank at the same time, you can't. Now you wish you had an emergency fund, just like individuals. Okay? Anyway, we should have a class next year just on what the heck went wrong, okay? And now I'm sitting here talking to an empty classroom. All right, hopefully you're still learning. That's the goal. All right. Hopefully some of you will go out and take over on the boards and understand some of these concepts. All right, discounted payback method and the payback method look at liquidity and risk. How quick do we get our money back? All right, now, discounted payback method uses weighted average cost of capital. The payback method does not. So let's talk a little bit more about the payback method. Why do we use it when it doesn't consider the cost of financing? Here's a big reason, because it's easy. You can have remember we talked about centralized and decentralized operations, chapter 10? Okay, so let's think about this. If you're the chairman of General Motors, you want to be making decisions, do I need to shut down a product line? Should I expand internationally? Should I negotiate with the union? Should I let them strike? Big picture items. Do we sell more SUVs? Do we cancel the sedans? Do I issue debt? All those big ideas, that's what we want them worried about. But what about the guy on the line, or the lady that's running production on the floor of a factory? They're the ones that know what goes on day to day. And they might have an idea that we can buy a machine and spend 50 grand, and if we spend 50 grand, it's gonna save us $30,000 a year in maintenance. Because the old machine, we don't care what we paid for it, because that's sunk cost, remember? Sunk cost we don't care about. I don't care what we paid for the machine, the old machine. The new machine's gonna give us, we're gonna spend 50 grand, is gonna save us $30,000 a year. A lot less maintenance. Maybe it runs more so we can produce more. Hopefully you watched The Profit, okay, at Grafton, where they showed you the machine planing the wood, and they said, why don't you buy a new machine? You could do the same work in a fraction of the time. Think of how much money you save on labor. Probably waste. Okay, so if I spend 50 grand on a machine, and it's gonna save me 30 grand, I'm paid back in sooner than 2 years. So what do I want the chairman of General Motors to work his way down? I want him to have a rule. Any investment that anyone can make that costs less than 100 grand, that were paid back in less than 2 years, go for it. So now we're empowering lower level supervisors and managers to make decisions and learn how to be the future executive. So now they're looking for opportunities to save the company money. They will now look, they'll say, how much does this machine cost? Maybe they read an engineering magazine, or maybe a friend works at Ford and told them about it, who knows? But they found out about this machine, it's gonna cost them 50 grand, they're gonna save 30 grand a year for I don't know how many years, but at least 2. So as long as it's gonna save them 30 grand a year from 2, they're gonna get paid back in less than 2 years. So if the rule was, as long as you invest less than 100 grand and you're paid back in less than 3 years, go ahead. So the supervisor does it. They buy the machine, their maintenance costs go down 30 grand a year, they're paid back in less than 2 years. Guess what? They've added the profitability to the firm. Guess what? When you add the profitability to the firm, maybe you're getting a bonus. Maybe the people on the line are getting a bonus too. All right? Because that's what you're doing with that extra money you're generating. You're helping profits. So shareholders get more dividends, employees get raises, employees get bonuses. You're empowering them to learn to make good decisions and move up to become that CEO someday that hopefully won't over-leverage his company by putting too much debt in his target structure to take advantage of lowering their target capital, okay, and weighted average cost of capital. You don't need to worry about it, except that's what went on. The stuff that we're talking about is what was going on in boardrooms. They were borrowing money cheap to repurchase shares and not invest it wisely in property, plant, equipment, R&D, and new products. So hence, when things go south, they have to make those guaranteed interest payments. They can't make them. They have to shut down their line. They can't sell product. They can't pay the debt. Boom. Bailouts, warrants, bankruptcies, fired from the board. This is all real world stuff. Okay? So anyway, we've now shown how the payback method, a simple method, doesn't use financing or weighted average cost of capital to empower lower level supervisors to see if something should be invested in. Discounted payback, what does it do differently? It uses the weighted average cost of capital. Okay. Where is my example for you? Discounted payback, writing in the notes. Let's draw our timeline again. Do not be embarrassed. Draw timelines. I still use them. Today is 0, 1, 2, and 3 again, right? 2 and 3. And again, we invested 12 grand today. We're getting 5 grand in each of the next 3 years. Doesn't matter if these are even or not. You'll be able to do these whether they're uneven. Okay? 5 grand. Weighted average cost of capital, I will give that to you. It's 9%. So now we do the same thing we did for net present value. We're discounting to day one, so we divide. The 5,000 divided by 1.09, divided by 1.09 to the second, divided by 1.09 to the third. This divided by this, we already did this for net present value, but it's the same numbers. But there's going to be one twist, 4208 and 3860. Now we start taking a look. We invested 12 grand. Did we get paid back at the end of year 1 using the, not the 5 grand, but the discounted amount? Can't hear you guys. Class participation time. Oh yeah, I forgot, we're on video. Okay, so no. Oh, they get the same result though, right? Okay, so 12 grand, we got 4587 back. We did not get paid back. How about at the end of year 2? We got this and we got this. What does that equal? That equals 8795. Did we get paid back? No. This number, we didn't get paid back at the end of 2 years. Year 3, we get 3860. Okay? How short are we? At the end of year 2, we are short 12 grand from 8795 is $3,205 short. We need that much more to get paid back on a discounted basis. On a discounted basis, we're going to get 3860 back. Don't use the 5 grand. We use the 5 grand to get this number. So we need 3205 of that, and then we're paid back. So what do? We take 3205 and divide it by 3860, and that equals 83%. That's 3205, 3860. 83%, or 0.83. So how long did it take us to get paid back under the discount payback method? 1 year, 2 year, plus 0.83. That's simple. We're still under the 3 years if that was the guideline. We're getting paid back in 3 years. If the payback guideline was 2 years, we don't do this project. If the payback period is 3 years, we could do this project because we're paid back on a discounted basis in 2.83 years. Where do people make their mistake? They'll take the 3205 by the 5 grand. Don't do that. We went to all this work to calculate this number for a reason. To figure out what the payback is on the discounted payback method. Again, payback and discounted, look at liquidity and risk. They give you some insight. How quick do I get paid back? Am I paid back quick enough to meet the goals? Yes. Okay? Questions, email them in. Use timelines. Understand the biases of each of these capital budgeting techniques. Net present value is the best. It uses interest rates, which is weighted average cost of capital, and all the future cash flows. Internal rate of return uses all the future cash flows, but makes the mistake of thinking all those future cash flows are invested at the internal rate of return. Modified internal rate of return corrects for that. it uses weighted average cost of capital to multiply to convert the future cash flows into one future value. Okay, and then we use the appendix to figure out if the modified internal rate of return is greater than WACC. Internal rate of return, we're looking, is it greater than WACC? Then we have the discounted payback method and the payback method that we just looked at. Payback method doesn't use WACC. The discounted one does use WACC. Okay. Done with my notes. We're right on time here. Okay. I want to now take a look at homework problems. Actually, what I really want to do is make sure this video is still working. We're good, we're at 55 minutes. You can fast forward through all the commercials. Well, we don't have commercials, so I guess this is like real time. This is like Netflix, right? No commercials. Sorry for that. But you can pause it and make your own commercial. All right. Now, I always struggle with finding this machine because I put it wherever. Now we're going to do half your homework problems for you. We're doing the half that will help you do the other half. That's the goal. These are all listed in Excel. Where are they listed? On Blackboard, under the learning module, underneath the videotape, maybe over the videotape, I don't know, wherever I put chapter 12 video. Here's 12.1. Please look at these before we have a Blackboard collaboration session. Does us no good if you're not familiar with the material. Okay? Please do that. I guess if you listen to this, you're probably already familiar with the material. So, okay. Here we are, 12.1. It gives us some information. It tells us that there were two projects. One is an initial investment of 55 grand, the other 50. They give you the useful life. They tell you the residual value of each. And they tell you what the total income over those years will be. And we're going to calculate, we're going to try and calculate. Thank you. Poltergeist. Stay out of here. Okay. We are going to calculate average rates of return. So for the first project, okay, our average investment is $30,000. That's the 55 plus 5. That's 60 divided by 2. That gives us 30,000. You can see that if you click on the cell with the 30 grand, it tells you C3 plus C5 divided by 2. That's 30 grand. What's the average annual income? That's 4,800. That's the 57.6. That's C6 divided by the 12. That's 4,800. What do? We take the 4,800 over to 30 grand, 16%. It's that simple. Add the investment plus the residual. If the residual is 0, then add 0. Divide by 2. That's your denominator. Average annual income, how much total income over the period? Divided by the number of years. 4,800, that's 16%. Same methodology here. 50 plus 6 is 56. Divide that by 2, you get 28. 63 grand for 15 years is 5250. 5250 over 28 grand, 18.75. These are give me problems. Especially since you'll have the practice set in front of you. Just don't have a friend next to you, or Skyping, or on the phone. That's not allowed. Have a little confidence in yourselves. You guys are doing great. Okay? That gets us to 12.5. I don't mind going through these a little quicker because, again, you can look at them anytime. 12.5 is a payback period. The last one was the average rate of return one. Here's payback. You invest $975,000. It tells you in part A you're getting 150 grand back a year for 7 years. So what do? We just start looking at it. If I invested $975 and I got $150 back at the end of 1 year, I didn't pay myself back. I'm still short $825. I'm short $675 because I've got paid back a total of $300 grand. $975 minus $300 is $675. And so on and so forth to year 6. 6 years of $150 grand is $900 grand. So I am still not paid back $75 grand. Since I'm getting $150 grand a year, I need half of the next year's $150. So I need half of year 7, so the payback period is 1, 2, 3, 4, 5, 6, and half of this year, 6.5. That's simple. Next, they make the payment stream varied. Same 975 grand investment. This time they tell us the cash flows coming back to us are a little more erratic. Same thing, 975 minus 275 gets us to 700. The second year we get 2 1/4 back. We're short 475. We get 180 back, it's 295. 175, we're short 120. And just by chance, we get 120 back. Boom, exactly paid back. 5 years is the payback period. We don't concern ourselves with these other periods that are beyond. That's one of the flaws of the discounted payback method and the payback method. It doesn't worry about future years. What it does do, gives you an idea that you're paid back in 5 years. That gives you some idea of the risk and liquidity and the problem. When do I get my money back? And in terms of time, how much risk am I taking? I'm taking 5 years of risk to get paid back. Again, you can see these in slow motion at your own pace on Blackboard under the learning module. We get to number 12.7. Again, we're doing half your homework problems here. But do them yourself. You'll have how I got to them. Do them, handwrite them out, because that's how you'll do them on the test. Okay? 12.7, weighted average cost of capital, 15%. We are looking for net present value, hence we need the weighted average cost of capital. The investment is 150 grand. It gives us 2 items. It gives us net income and net cash flow. We don't care about the net income when we have the net cash flow available, because net income, remember, is reduced by things like non-cash transactions, namely depreciation. Okay? Could also be gains and sales on the sale of assets. We talked about that in chapter 3. Okay? We're not going to worry about that. We want to use the net cash flow when we're discounting. Okay? We use the income in that average return problem that's off by itself, 12.1, which I think is 12.3. Okay, we're not using this, we're using these numbers. So what do? Think about this. This is our timeline that we had 0 and 4, 1, 2, 3, and 4. And what is our cash flow? We get 80 grand this year, 65,000 this year, 50 grand here. Here, let's make these bigger. Hopefully you can see them. This is year 4, 3, 2, 1, and 0. 80,000, 65,000, 50,000, and 40,000. Weighted average cost of capital is 15%. So what am I doing? I'm dividing this by 1 plus the weighted average cost of capital. We're dividing. Divide. Because we're discounting to get what these are worth today, day 1. D. Divide by 1.15 to the second power. Divide by 1.15 to the third power. Divide by 1.15 to the fourth power. What do we get? We get the answers there. 69, 565, 49, 149, 38, 32,876, 22,870. Add those up and you get the present value. Subtract the initial investment of 150. We have a net present value that is a positive number, positive 24,460. We do the project because the problem came out that the net present value is positive. Please don't forget to subtract the investment to get net present value. This is not net present value. This is present value. Questions? Email them in. ask them on Blackboard, collaborate. Text a friend, okay? That should really be, you try it. Your first thing is check with one of your pals. Don't spend a whole lot of time on that after not helping. Send me an email, okay? So that we know what we're doing here. I'd say take a picture of this, but you don't have to. Just rewind. We're already on 12:09. Our class is normally an hour and 25 minutes, so with you guys not asking any questions, which is kind of like usual, just kidding, don't write that in the evaluation. Oh, you're going to write it. Okay. Maybe I should delete that comment. We'll go with it. All right, anyway, 12:09. Just trying to break this up a little bit here. It's given revenues are 30 million. It's given that our expenses are 23 million and that they include depreciation. Once the problem says depreciation, we should have our antenna up. Because we should know from way back in chapter 3 and 4, to get cash flow, we add back depreciation. So 30 million minus 23, that would get us to 7. Add the 2 back, what's our net cash flow? 9 million of cash flow. All this builds on the stuff from way back when. This is why I was so hard on you guys in the beginning. I wanted to make sure you understood the balance sheet and the income statement and the cash flow statement, because it's just chased us all the way through this book. All right, so now we're going to show you on Excel, when we get to a test, 2, 3, maybe 4 periods, okay? I'm not going to make you discount 25 periods. If you can do 3 or 4, I know you're good, okay? This is just to kind of show you what it looks like in Excel, how good Excel is for really complicated, long problems. And we're going to learn one more little trick in Excel today. So the cash flows that we just figured out were 9 million a year after adding back depreciation. 30 million in revenues, 23 million in expense, that gets us down to 7, add back the 9, add back the 2 for depreciation gets us to 9. That's our cash flow. Boom, 25 years it says we're getting this. So put that down for 25 years. And then what do? We're discounting. So we're dividing. We're dividing C68, 9 million by 1 plus the weighted average cost of capital, raised to n. Year 1, n is 1. Year 8, n is 8. So hence, you can see my formula here. C6, if you can't see it here, look on Excel, on Blackboard, okay? Just click on any of the cells. C68 divided by 1.14 raised to the B68 power. B68 raised to the first power. That gives us this. When I walk down to this one, I just copied the formula all the way down. C69 divided by 1.14 raised to the B69 to the second power. And so on and so forth. Saved me a lot of typing. I was able to do this problem in about a minute. Okay? 25 years, Excel, boom, done in a minute. So what does that all that get you? 1.14 raised to whatever, all the way down to the 25th power, down at the bottom. And you should also know that the value of this 9 million, what it's worth today, is a fraction of $9 million today because of all the discounting going on. This 9 million is divided by 1.14 to the 25th power. 1.14 to the 25th power. Again, I'm not going to give you 25 periods on a test. 3, maybe 4. So then we use that at sum feature. Sum equals sum D68 all the way down to D92. Add those up and I get 61,856,347. the book told us the initial investment was 50 million. If it was 50 million, that's the present value minus the investment gives us the net present value, 11,856,347. Questions? Now we'll go one line lower. Excel has a formula. So we did it in Excel, but Excel has a shortcut. They have a formula you could use to get to the present value. You would then have to subtract the investment still to get the NPV. What's the formula? Equals NPV, parentheses, put the weighted average cost of capital, so equals NPV 0.14, which is the weighted average cost of capital, comma, C68 dot dot C92. Or you could again just drag on them all. Okay? Boom, it'll give you the answer. Alright? Couple different ways to get there. Subtract the 50 grand to get the, you always got to remember to get net present value, not just present value. Look at the cell to get what I'm scribbling here. That's 12.9. Which is all the homework problems I'm going to do today. There's one other set of practice problems that you really should look at because they'll probably be the ones I lean to when I get to making the test, which I haven't done yet. Because today is actually, what is today? Saturday, the 21st of March. It's a nice sunny day. It's still chilly out, but since some of you won't be reading this in April, again, we're short sleeves, okay? This not eating out every day is killing me too. I think I've lost like 4 or 5 pounds this week. So you won't recognize me next year if this continues. Let's go to Blackboard. And take a look at the practice set problems that I strongly encourage you to do. Let's find them. I'm going to go to, don't forget my notes for chapter 12 are here. I updated them this morning. I added some color and a few extra comments. I'm trying to make this as easy as possible for you. So please look at the notes before you watch the video. It's kind of hard now because you've already listened to the video. But anyway, you kind of knew that. Chapter 12 examples. They're right here. And chapter 12 practice set answers. Do those. If you can do those, you will be highly successful on the chapter 12 part of the math test. Okay? So you got those. I'm not going to work through them today. You work through them. Send me your questions on them. Don't forget the appendix is in the back of the book. Mark it down now so you don't mess it up on the test. A5 is for internal rate of return. A3 is for modified internal rate of return. Understand the pluses and minuses of each technique. Get a calculator. Right? You're sitting at home anyway. You can go click online, order one. Texas Instrument BA2 Plus. I think I noted it in the syllabus, so you can go back and check that you're getting the right one. Buy a used one, $10, $15 max. Maybe there's someone hanging out from my last class that has it. You'll use it in Finance 350 extensively. If you don't believe me, ask the kids in this class. that you know that have my Finance 350 class. Those who continually try to prove me wrong that they don't need it, usually change their mind after maybe the second, but for sure the third test in Finance 350. Okay? Hard to complete my test without a good financial calculator. That ends today's talk. Hopefully I've already seen everybody on Blackboard Collaborate. Maybe we'll see you again. Good luck on the test. I love teaching this class. You guys have been good. You battled through this. Communicate, all right, until we get through the final. Have a great summer.